There's a big misconception out there that a lack of volatility means a lack of risk, but ultimately what really matters is the time frame for the money that you have and the ultimate goal that you're trying to achieve. So in today's video, we are going to break down the risks associated with cash and bonds and inflation. Welcome to Cup of Bull. My name is Michael Dunham. With me today is Patrick Fontana, the founder of Fontana Financial Planning.
Cheers, Michael.
Cheers. So Patrick, to get started, I wanted to first ask you what a bond is. So if you can just break down what is a bond, or also referred to as fixed income, and how does fixed income work?
Sure. So in its simplest sense, I like to think of being an owner or being a loaner, right? And you can do that with a few different things. If you look at a company and you buy shares in their stock and you own some of the company, that's owner. If you loan money to that company, you buy some of their bonds and the company then owes you money. And typically they pay interest every 6 months and they have a maturity date. So let's use an example of a 10-year bond that you get a 5% interest rate and a 10-year maturity. $100,000, they're going to pay you $5,000 a year for 10 years. And at the end of the 10 years, give you the money back. So that's the way a bond functions. And in that example, a corporate bond, you name the company, could be Apple, Exxon, Intel, any public company. You can also do government bonds where you're loaning money to the government, or some other entity, municipal bonds where you're loaning to a municipality. But those are bonds.
So that all sounds great. So what's the downside of owning a bond, or the negative associated with it?
So the one thing I've personally experienced is what I call statement shock. A lot of people don't understand the actual risk in bonds pricing. So I'll use an example of a local Dallas widow who had an SMU bond that was the first few years that I knew her. She had this bond and interest rates went down. So interest rates got cut down, down, down. And when that happens, the value of her bond went up, right? So on her statement, the value went up. And then for the first time, when interest rates moved the other direction, where she actually saw it, her statement value from 1 month to the next changed. And it was a bit of a shock to her. So I had to explain this scenario of how bonds price. And it makes sense when you understand that there's an inverse relationship. You know, rates go down, bond prices go up. Rates go up, bond prices go down.
Yeah, and one thing I'll add, in my experience, the people who own bonds, like, have a high percentage of their overall net worth is invested in bonds, are people that I'd say are very conservative individuals, where that's the most important thing to them, right? They want to avoid seeing the number on their statement go down at all costs. Two big, I'll say, opportunity costs, or in the long-term risks that a lot of times those people are not thinking about, is one, the opportunity cost of having a higher level of return over a longer period of time. And then two, inflation. So on that note, Patrick, can you just break down first, I guess, expectation wise, what is the difference between what somebody may expect to receive if they own bonds versus if they own equities or stocks over the long term?
Right. So let's look at say that 10-year time frame. If you invest in a bond and you have a fixed payment for the 10 years, the fixed payment doesn't go up. It stays the same the entire 10 years. And you do know what you're going to get back, which is the 100,000 you purchased, you get 100,000 back after 10 years of paying interest. But inflation, which I like to call the silent killer, averages about 3%. And so over that 10-year period, if you've got inflation of 3%, that money you get each year is worth less as far as purchasing power, which is really the ultimate thing. The important thing is, what can you buy with this money? And if that doesn't change 10 years later, you're getting the same income, but it can't buy nearly as much. That's a problem. And if we offset that with the alternative, which is owning stock, owning a piece of the company that pays a dividend and typically raises the dividend over time, that dividend can be expected to go up over the 10 years, and the purchasing power can stay ahead of inflation. And that's typically the way I've seen it work pretty much over every time frame you slice it. Owning good companies that pay dividends and raise them over time beats the silent killer and stays ahead of inflation. If people are too heavy in cash and too heavy in bonds or fixed income, they don't get those raises, and inflation comes along and sneaks up on them, and they may be preserving their money and preserving their payment, but the purchasing power just goes away.
Yeah, one common misconception I'll say that's out there too is as people approach retirement and enter retirement, they think that their time frame becomes significantly shorter, right? I retired, I need some of this money tomorrow, therefore I need to get very conservative with my investments. And the reality is, the average retiree that makes it to 65, one of the two members of the household is going to live most likely at least until age 90. And it's also very rare that they're going to run out of money, where some of that money is actually going to pass down to the next generation and have an even longer time horizon. So that's one thing that we try to really focus on when it comes to investments with our clients is, even though you're starting to draw on this money to cover a lifestyle, that doesn't mean that all of the money is short-term money. I'll also say that this is where having a well thought out financial plan can be very valuable, where you can understand the time frame that's associated with the money that you have, and understand the dividends that are going to get paid out most of the time, regardless of whether the market is up or down. And having a fully funded emergency fund, or we like to call them war chests, that you can turn to if the market is down, to be able to cover a year of expenses, 2 years of expenses, sometimes more. So all of these things, it's not that you don't ever want to own any bonds, but having a good financial plan where these variables are well thought out can allow you to have a longer term perspective with typically more of your money, which benefits your family over the long term on average.
Mm-hmm. My buddy Nick Murray has a term. He calls it the toxic illusion of keeping our money safe. And you can win the battle and lose the war, really, when you ignore the silent killer, the dragon of inflation. And an example would be, someone's got $1 million, they put it all in fixed income. It's ultra safe. It's AAA, highly rated, everything. They're guaranteed to get this money back. And they put their arms around it. They put a moat around this $1 million, and they're like, I'm not going to lose this money. And over time, the 10 years, 20 years later, they've still got the $1 million. They didn't lose it. But how much is it worth? Well, that purchasing power of the $1 million changed significantly, and they kept the million the way it was, but it didn't keep up with inflation, and it's worth much less.
Thank you so much for joining us on today's episode of Cup of Bull. If you have any questions about your specific situation, we do have a link down below in the show notes where you can schedule a time to have a introductory phone call with a member of our team. That said, Patrick, how do you want to wrap us up today?
Well, I think before we do our rebalance, let's say be an owner, not a loner most of the time, and rebalance until rich.
Cheers.